We have got a roller coaster ride happening in the oil market. Crude oil was at a 5-month low earlier, and then it bounced back. It looks like NYMEX crude's going to settle up 2.8% higher, or $1.02, 36.81 to settle at 36.81 a barrel. I want to talk more about oil now and the outlook for the sector, especially post this election, with Regina Mayer, KPMG's global head of energy. Regina, thanks for being with us. Just first off, what do you make of the activity we saw today in the oil market, sort of giving investors a little bit of whiplash?
Well, I think the market, frankly, overreacted, but we do still have a lot of concerns about demand. So I think that's what's being the big driver. With the new lockdowns coming in Europe, the sector is already embattled, and it has been worried about demand. In fact, you have two CEOs that have said they believe 2019 was peak demand going forward. So I think that's what happened in the market. But you also see some of the supply that's a little bit restricted. While we see rig counts inching back up, they went up 9 rigs last week, 6 straight weeks of increase, but that's still 36% of what it was last year. So I think we still see a lot of supply and demand puts and calls. I think the market overreacted. It should be around high 30s, 40s, where it was the last few months, pretty stable. But I think that's what happened.
I want to talk about supply for a moment, because Libya back in the picture. A supply of oil from Libya, how does that threaten prices or weigh on prices right now?
Well, I think that's why you see OPEC Plus starting to talk about extending their supply cuts, because there is oil coming back on from Libya. The Permian curtailments, the economic curtailments that the super majors made, those are all coming back online. So we see supply starting to inch back up. And I think we're still trying to thread the needle. And with the additional COVID restrictions coming on board, which will dampen demand, then we see some downward pressure on price.
Hi, Regina. I want to ask you about the majors. We're just getting some earnings in from them recently, notably Exxon and Chevron Friday. The bar has been set incredibly low for them, but can they really expand? Can they really continue with some of the plans that they've made over the last few years? For instance, Exxon did that really hard pivot to pivot away from its strategy over in the year. Are they going to get back on track, or are things just permanently changed now?
Clearly, the sector is embattled, but Q3 was better than Q2. I mean, we got to talk about what's relatively speaking where we focus. You did see all of the super majors talk about net carbon zero commitments or decarbonization efforts. I think that's an effort around pivoting. Some are pivoting harder than others. But let's face it, some of these decisions that have been made are decades-long decisions, and it takes quite a while to reshape your short-term strategy in the context of your long-term strategy. I still think the sector is a safe bet. Clearly, it's under a lot of pressure right now, but we still need fossil fuels, and we don't have serious alternatives that can eradicate them. So how do we manage these assets toward an end of life? And there's a lot of really strong operators that are safe pair of hands. That's the case they're going to try to make as we wind down our reliance on fossil fuels over a decades-long approach.
I want to talk about the election for a moment. And if Vice President Biden were to win, there's a chance that the strict U.S. sanctions on Iran's oil exports could be eased, potentially paving the way for millions more. I think it's 2 million more barrels per day of Iranian crude oil exports returning to the market. What would that do to oil prices?
I think it would cause a lot of downward pressure, and it would be significantly harmful to the overall price. I don't believe that the oil can come back immediately. I believe that you'll see some staging and sequencing of supply coming back online. But you're right, that is probably an outcome of a Biden administration. But there is lots of oil, right? The world has a lot of supply, and we're experiencing restricted demand due to COVID. And so it's going to be a lot of downward pressure on oil price, which means downward pressure on earnings. And so we're going to have to see continued CapEx and OpEx cuts as we go forward. And that's why the sector will continue to struggle.
Sticking with the election, fracking has become a major issue in this campaign. It's huge for voters in Pennsylvania. How are you, from your perch there at KPMG, viewing fracking as you look at the overall oil sector?
I think it's something we need. I mean, our sector has demonstrated that we can provide not just energy independence and energy security, but energy dominance, right? We are a major factor in those oil supply calculus that you were just talking about, Alexis. So fracking is an activity that I believe is here to stay. There will be potential threats to that activity depending on what administration takes hold. But I also think it's so pervasive that it would be really hard for things to just turn on a dime. So I'm not really worried about the threat to fracking. I think it's a technology that's very useful and is very much here to stay.
I wanted to get your take on some of the other energy markets, especially looking at the futures here. Natural gas happens to be off about 3% today, but it's been on quite a wild and volatile ride. I think it's up 75% over the last 3 months. Heating oil also elevated too. Of course, we got its own independent dynamics as we head into winter. What's your take on these different markets?
Well, Jared, I think you hit the nail on the head. Those are some of the bright spots of what we're seeing in the market. My last business trip was in Pittsburgh, Pennsylvania, talking to some of the Marcellus gas producers. And I walked out of there saying, I would not want to be a dry gas producer in today's world. Well, boy, was I wrong, right? That was when natural gas was at $2.50 per MMBTU. It's up over $3. I think gas is a big part of the energy transition and could be a bridge fuel. And you're seeing that gas is being valued in that regard. Plus, with the curtailment of oil production, you have less gas that's a throw-off product, and that makes the gas that is produced organically more valuable.
All right, we are going to leave it there. Regina Mayer, KPMG's Global Head of Energy. Good to talk to you today. I'm sure we'll be talking to you again in the weeks to come after the election.